Picture this. In the halls of Mexico's Congress, the gavel comes down hard. A massive hike in tariffs is approved, up to 50% on steel, plastics, and textiles, measures aimed squarely at one target: China. It looks like the ultimate checkmate.
Right.
Washington has spent years pressuring Mexico to close the back door into the American market, and finally, the door hasn't just been closed, it's been slammed shut and bolted. You expect the reaction from Beijing to be explosive.
Absolutely. Usually in a trade war like this, a punch is immediately followed by a counter-punch.
Yeah.
You expect furious threats, retaliatory sanctions, or at least a loud diplomatic tantrum.
But instead, something unsettling happens. Complete strategic silence. The response from Beijing wasn't a roar, but a shrug. State media merely called it a step backward, almost yawning at a move that destroys billions in potential trade. Why? Why would a superpower accept such a humiliating defeat without a fight?
What makes you wonder if we're misreading the board entirely? It's the grand paradox of this situation. I mean, we are so conditioned to see global trade as a zero-sum game played across a single, focused field. But what if the opponent you thought you were playing against had already calculated that loss and simply
rotated the entire board?
Precisely. While the U.S. is celebrating successfully blocking goods from crossing the Rio Grande, Chinese executives are quietly looking at a map, realizing they don't need to cross that river at all.
And that's the core thesis of this deep dive. They aren't trying to break into the fortress anymore. They've decided to buy and build the rest of the neighborhood. The U.S. thinks it just won a decisive battle.
But it might have just forced its opponent to start a much more strategic long-term campaign.
We are unpacking the idea that while the U.S. tried to seal its northern border to Chinese goods, that action inadvertently forced China to execute a larger pre-calculated pivot, turning its focus from using Mexico as a U.S. market entry point to establishing comprehensive economic dominance across the entire Latin American region.
And this strategy, it's built on long-term foresight and really comprehensive engagement.
Okay, so let's start with that initial geopolitical pressure point.
Yeah.
The U.S.-Mexico border. This was an incredibly intense battle, and the U.S. was absolutely unequivocal about its goals.
It was. We know U.S. Trade Representative Catherine Tai was very public about the fact that the U.S. was prepared to use all its tools to counter what it saw as China's blatant circumvention attempts through Mexico.
And the political rhetoric was ramped up significantly. It went beyond a mere trade violation. They framed it as a critical national security issue. That's a massive hammer to drop on a neighboring country.
It's a huge deal. Framing it that way changes the entire conversation. It's not just about economics anymore. The idea was that China was setting up these manufacturing plants in Mexico, taking advantage of Mexico's access to the massive North American market via the USMCA trade agreement.
And effectively undercutting U.S. manufacturers from within the free trade zone.
Exactly. The entire push for nearshoring, where companies bring supply chains closer to the North American market, was always, contingent on keeping Chinese competitors out of that triangle. The U.S. leaned hard on Mexico to stop offering federal incentives.
Things like cheap land, tax breaks, favorable energy rates.
All of it, especially to Chinese EV makers. That was a clear line in the sand.
And that pressure had tangible, immediate results. We saw the concrete consequences when the Chinese electric vehicle giant BYD, which is in the midst of this massive global expansion.
They indefinitely postponed their plans for the major factory in Mexico. And they didn't hide the reason. They explicitly cited geopolitical issues.
Billions in potential investment and thousands of jobs just put on hold.
It was a very public concession. I mean, the U.S. policy, in the short term, it worked. They blocked the most visible, high-value attempted backdoor.
But here's what's really intriguing, and what we opened with. China's reaction to this immensely costly defeat. That quiet acceptance, calling it just a step backward. Why the strategic silence?
What was the calculation behind choosing not to fight back diplomatically? Or, launch swift, specific counter-sanctions against Mexican goods?
Right. If they had retaliated, what would that even look like? Slapping tariffs on Mexican avocados or specific manufacturing inputs?
They could have, but a noisy retaliatory response would have been perceived as non-strategic, maybe even weak.
Right.
You have to look at the immense economic gravity pulling on Mexico.
The United States is Mexico's #1 trading partner by an overwhelming margin.
By a mile. The economic and political weight the U.S. holds in that bilateral relationship is absolute. So if China had chosen to throw a massive diplomatic tantrum or threaten retaliation focused solely on that border dynamic,
they would have accomplished nothing. It would have just forced Mexico into an impossible geopolitical bind.
and crucially, it would have made China look politically impotent on the global stage. They would have been shouting into the wind.
So their calculated move was strategic indifference. It was a recognition that this was a specific battle they had already calculated they couldn't win, and a refusal to waste vital diplomatic capital on a door that was already locked.
Precisely. They took the loss, ate the cost of the BYD postponement, and immediately pivoted. The diplomatic energy and corporate capital that would have been wasted fighting those tariffs were instantly redirected.
And the new mission wasn't crossing the Rio Grande anymore.
No. It shifted to making Mexico the central hub for dominating the entire Latin American market, targeting the immense consumer bases and raw material sources in Brazil, Argentina, Colombia, everywhere south.
That takes immense corporate composure and foresight. I mean, you don't just change the destination of billions of dollars in supply chains overnight without a deep underlying plan. How quickly did this logistical shift manifest on the ground?
It happened almost instantaneously, and it reveals a level of adaptability in Chinese corporate strategy that, frankly, we often underestimate. The high-level political move was mirrored instantly on the factory floor.
There's a story that really captures this, right? It grounds this high-level geopolitical decision in the practical reality of running a business.
It does. It's a fascinating account. Picture a factory owner named Chen. He runs a mid-sized aluminum component plant near Monterrey, a major industrial city in Mexico famous for its proximity to the U.S. border.
The perfect spot for that backdoor operation.
Exactly. For years, his routine was clockwork. Raw materials arrived from Ningbo, were processed using low-cost Mexican labor, and immediately trucked north across the Rio Grande to Texas, destined for the massive U.S. auto sector.
The quintessential model the U.S. wanted to shut down.
Right. But when those new 50% tariffs hit, the orders from his American clients vanished. I mean, almost overnight. His entire business model was destroyed in a single vote.
So Chen had two options, protest, lobby, or shut down.
But he did none of those. Instead of panicking or protesting a battle Chen knew was lost before it began, he simply laid out a new logistics plan. He gathered his managers not for a crisis meeting, but for a planning session.
And he pointed not north,
but dramatically south. He rotated the board.
Incredible.
He detailed new shipment routes. He explained how they would retool the machines, minor adjustments to meet different regulatory and consumer specifications for the South American market. Instead of going to the border city of Laredo, the finished components would now head to Veracruz.
On the Gulf Coast.
Yes, destined for assembly lines and infrastructure projects in places like Colombia, Chile, and even deep into Brazil.
So the underlying raw material flow from Asia is maintained, but the final delivery point and the end user changed entirely. The components are still traveling a vast distance, but now they are integrating into a south-south supply chain.
And there was a famous quote attributed to him. He said, "The door north is closed, but the hallway south is wide open."
Wow.
That is a perfect encapsulation of strategic fortitude. It shows that for these executives, a blocked path is simply a signal to rotate the entire system. This pressure, intended to contain China and slow its industrial momentum, is actually forcing a rapid maturation.
And strengthening of new, dedicated supply chains within Latin America itself, making them more resilient and internally integrated.
And this rapid shift accelerates the profound transformation of Mexico's role in the global economy. It's no longer just a dependency of the U.S. market. It's being forced to evolve into something much more autonomous and strategically central to the entire region.
It's being forced to diversify its economic portfolio.
Precisely. It transforms it from a mere U.S. dependency, a manufacturing annex to Texas, into a strategic pivot point for the entire Spanish-speaking world. It forces Mexico into the role of the grand connector of Latin America.
Which is a key insight into how geopolitical pressure inadvertently reshapes regional dynamics. In this case, in favor of greater interdependence and autonomy within the global south. It changes the entire focus of Mexican manufacturing and logistics from being unidirectional north to continental,
connecting Asia to the entire continent below the Rio Grande.
This sets the stage beautifully for our next segment, because a pivot this quick and clean isn't an improvisation. It can only happen because the foundation was laid down decades ago. If the tariffs were the trigger for Act 2, we need to understand the comprehensive groundwork of Act 1.
That's absolutely right. The ability to execute a rapid pivot like this depends entirely on 2 decades of calculated groundwork. This isn't just about trade, it's about a comprehensive grand strategy of deep structural engagement.
The change in China's economic role in Latin America and the Caribbean, which we call the LAC region, is just staggering.
It is. Staggering is an understatement. If you look back to the start of the millennium, say the year 2000, what was China's standing in this region?
Almost nothing, right?
A truly peripheral actor. China accounted for less than 2% of the region's total exports. The region was completely dominated by trade with the U.S. and Europe.
And today?
Today, China has transformed into a central economic and strategic force. It is now Latin America's second-largest trading partner, having decisively surpassed the European Union. And in resource-rich South America, China is already the undisputed top trading partner, having overtaken the United States in that sub-region over a decade ago.
That speed of ascent from 2% to becoming the second-largest partner globally is phenomenal. Let's put some numbers on that for you. What does that growth look like in sheer magnitude?
The numbers are explosive and, hard to grasp without context. Between 2000 and 2020, trade grew 26-fold.
26 times.
It skyrocketed from $12 billion to $315 billion. By 2023, the total value of China-LAC trade had already reached $478.9 billion. This is a nearly $500 billion annual flow.
And it's not slowing down.
Not at all. The projections indicate that this trajectory isn't slowing. Analysts forecast that trade is expected to double again, reaching over $700 billion by 2035.
That forecast alone, hitting $700 billion, puts them on a direct trajectory to compete fiercely with the U.S. for the overall top spot within the next decade.
It does. And this foresight has to be built on a structured, phased approach to engagement. We can actually detail that historical timeline.
Let's do that. How can we map the intentionality of this strategy?
We can break it down into 3 clear phases. The first was the strategic exploration phase, which began from about 1993 to 2002. This was a period of initial reconnaissance, signing early bilateral trade agreements, establishing embassies, and engaging primarily with resource-rich nations like Brazil and Chile.
Laying the political groundwork.
That's all it was. Then came the second and most explosive period, the strategic development phase, from 2003 to 2013.
What fueled that explosion?
This decade was significantly fueled by 2 massive reinforcing factors. China's own unprecedented demand for commodities during its infrastructure boom and the resultant Latin American commodity supercycle.
I've heard this decade described as the greatest win from the commodity lottery in Latin American history.
It really was. It drove an average annual economic growth of 4.8% across the region. China essentially became the engine for a golden decade of growth by absorbing massive amounts of raw materials.
So the region supplied the raw materials, and China supplied the cash and the demand. But that sounds like a heavy dependence on external factors on a commodity boom. What defines the current phase?
Well, the current period, from 2014 to the present, is what we call the strategic improvement phase. This phase is less dependent on external factors like those commodity booms, which have cooled since the early 2010s, and it's more driven by endogenous factors.
What do you mean by that?
It's characterized by increasing interdependence, conventional and predictable relations, and a shift toward higher value engagement. It's moving beyond just raw commodity extraction. This is the making of what analysts call a post-boom paradigm, where the relationships are structural and permanent, not cyclical.
And as those economic ties deepened, it was essential to build the political and diplomatic framework to support them. This suggests that the relationship is far more than just transactional trade.
It is absolutely not just transactional.
Yeah.
China has systematically deepened political ties through formal diplomatic achievements, using specific diplomatic labels to distinguish the depth of partnership.
You're talking about the comprehensive strategic partnerships, the CSPs.
Exactly. These are generally regarded as the highest level of bilateral relations, involving intensive government-to-government consultation and coordinated action.
So for you listening, what does that designation, a comprehensive strategic partnership, actually mean in practical terms? Why does that diplomatic title matter so much?
It matters because it accelerates the entire relationship. A CSP designation often unlocks preferential access to high-level financing, faster approval for major infrastructure projects, and the establishment of dedicated high-level working groups focused on technology transfer and defense.
It allows for seamless coordination between ministries.
It does. And China has CSPs with 7 of the region's major economies or resource holders: Brazil, Mexico, Peru, Argentina, Venezuela, Chile, and Ecuador. That's a massive diplomatic and economic bloc locked into the highest level of relationship.
And we see this high-level commitment reflected in presidential attention, right? It's not just diplomats, it's the heads of state.
It is. The commitment is visible in the sheer frequency of high-level interaction. President Xi Jinping, between 2013 and 2024, made 6 visits to the LAC region.
And just to put that in perspective for you, that's more frequently than the last 3 U.S. presidents combined.
That is. This high frequency ensures that the relationship is maintained at the strategic top level, reinforcing political trust and coordination, and it often results in major policy and financial agreements getting signed.
Can you give us an example of how one of those presidential visits translates into concrete cooperation?
Sure. Look at the 2024 visit. President Xi elevated the partnership with Brazil, which already holds a CSP, to the level of a China-Brazil community of shared future. Now, that might sound like diplomatic jargon.
But it wasn't.
It wasn't. It resulted in the signing of 37 international agreements spanning everything from trade, energy, mining, and finance to satellite technology cooperation. This is deep structural integration managed at the highest political level.
Okay, so bilateral ties are crucial, but China is engaging with 33 distinct nations in the LAC region. How do they manage collective cooperation and regional consensus building? They can't just handle them one by one.
That's where the collective cooperation mechanism comes in, and it's a masterpiece of diplomatic efficiency. In 2014, during the first China-LAC summit in Brasilia, China introduced the China-CELAC Forum, or CCF.
CELAC being the Community of Latin American and Caribbean States.
Correct. This platform is the vehicle for collective cooperation, designed specifically to maximize the advantages of large-scale region-to-region dialogue.
So it's essentially a dedicated multilateral platform, and it notably bypasses organizations where the U.S. or other Western powers might hold dominant influence, like the Organization of American States, the OAS.
Precisely. It's part of China's global framework for collective cooperation with developing regions, similar to its forums with Africa and Arab states. It ensures that dialogue is streamlined and efficient. Adam Ratzlaff, a specialist in inter-American affairs, highlighted that the CCF consolidated Chinese multilateral engagement in the LAC region into a single identifiable channel.
It gives both sides a clear path for large-scale planning.
It does. And what this forum achieves on the ground, beyond just dialogue, is setting these long-term cooperation agendas. For example, the third ministerial meeting in 2021 was explicitly focused on promoting smart, digital, and green development initiatives.
So not just buying soybeans anymore.
Not at all. China pledged special loans for development cooperation and digital economy projects, as well as funds to support CELAC member states in addressing growing food security issues. The focus has decisively shifted from merely purchasing commodities to investing in the region's future capacity in high-tech and sustainable sectors.
So China built the diplomatic superstructure first, locking in political commitment and efficient regional dialogue channels. Now it's time to pour the concrete.
Which leads us directly to the physical integration, infrastructure, and connectivity.
Right. Controlling the logistics is the engine of the entire strategy.
After establishing these deep diplomatic channels and political partnerships, the next logical step was to integrate the region physically into China's vast global infrastructure development strategy. And this is achieved primarily through the Belt and Road Initiative, or BRI.
The BRI is China's signature global infrastructure plan. When did it officially extend to Latin America, and how large is the scope of engagement?
It officially expanded to LAC in 2018. Since then, 21 of the 33 Latin American and Caribbean countries have formally signed memorandums of understanding. This mechanism mobilizes massive Chinese capital, primarily through state-owned enterprises, or SOEs, and export credits.
And the spending is colossal.
It is. Estimates suggest over $1 trillion in spending worldwide, and a significant portion of that is now dedicated to physical links like ports, railways, and power grids in Latin America.
This mechanism is how China facilitates extensive investment in transportation and logistics, creating the physical links necessary for deep integration. And the crown jewel of this entire physical strategy right now seems to be the massive Chancay Megaport in Peru.
It is arguably the most significant single infrastructure project in the Western Hemisphere right now, purely from a geopolitical trade perspective.
Let's break that down. We're talking about a proposed $3.5 billion deepwater megaport in Chancay, Peru.
And it's majority owned by the Chinese state shipping company, COSCO Shipping Ports. This is explicitly designed to establish a direct, high-volume Shanghai to Chancay shipping lane.
Which would fundamentally shift the geometry of Asian-LAC maritime trade.
Completely. A deepwater port on the Pacific coast that can handle the massive post-Panamax vessels is huge. It's expected to be inaugurated at the Asia-Pacific Economic Cooperation Summit in Peru this November.
So what is the key strategic consequence of this deepwater gateway? What does this mean for trade?
The core consequence is a geographical revolution. For the entire Pacific coast of South America, countries like Chile, Colombia, Ecuador, and Peru itself, this megaport will reroute substantial trade volume. Instead of shipping north to the U.S. or crossing the continent via the Panama Canal.
It creates a much faster, more efficient direct route to Asia. Wait, let's stop there for a moment. This reroutes trade volume, bypassing the Atlantic Ocean and, critically, the Panama Canal.
Yes.
The Panama Canal handles about 5% of global trade. Is China actively trying to reduce its reliance on that crucial waterway?
That is the clear interpretation. Historically, China has been the canal's second largest user, and Chinese-tied companies have long held significant stakes in Panamanian infrastructure. For instance, a subsidiary of CK Hutchison Holdings, based in Hong Kong, has operated 2 of the canal's 5 port terminals since 1997.
So they have a long-standing commercial interest.
They do, but relying on the canal exposes them to geopolitical risk and increasingly environmental and logistical bottlenecks, like the recent severe droughts causing transit restrictions.
So the Chancay project represents a strategic shift.
It is a shift from merely using the existing global trade artery to building a powerful, high-capacity, dedicated, direct alternative. It reduces logistical dependence on a choke point that is managed by other powers and subject to environmental constraints. It secures a direct Pacific gateway for the enormous raw material and finished goods traffic.
Moving from these mega projects to the financial context, you mentioned that China's financial engagement has matured significantly. What does that look like when we analyze the flow of capital? Because this is a critical sign of long-term sustainability.
We see a major transition in the financial tools being deployed. It's moving from government-to-government lending to market-driven, project-based financing. Historically, the relationship was dominated by sovereign development finance.
Specifically, massive loans issued by the 2 primary Chinese policy banks, the China Development Bank, CDB, and the Export-Import Bank of China, CELAC.
Exactly, and the scale of those policy bank loans was just monumental.
Remind us of the scale.
Historically, between 2005 and the peak period of 2009-2016, those 2 policy banks loaned over $141 billion to LAC countries.
That figure was more than the World Bank and the Inter-American Development Bank, the IDB, combined during that same time frame.
It was, and these loans often secured raw material supply agreements in return.
And now that lending has fallen dramatically.
Yes. In 2023, these direct state-backed loans were minimal. It was mostly just 2 major loans to Brazil's BNDES. And this is significant. It signals that the relationship no longer requires massive state intermediation and government guarantees to initiate engagement.
So if the state-backed DFI loans are dropping, but the infrastructure engagement is accelerating, where is the capital coming from now, and why is this considered a sign of maturation?
The capital is shifting toward direct project risk in infrastructure contracts. In sharp contrast to the declining DFI loans, the value of infrastructure contracts, which are the direct provision of services by Chinese firms to build or operate public infrastructure, has more than tripled as a share of LAC GDP between 2020 and 2023.
Okay, so we're shifting from a model where the Chinese government acts as the banker, lending money to Latin American governments, to a model where Chinese construction and engineering firms are winning contracts outright based on their merit and price.
Exactly. This shift is the definition of maturation. It reflects Chinese firms gaining local experience, establishing strong local partnerships, and becoming highly competitive in the local market. They're relying less on state DFI intermediation to guarantee projects.
They're taking on project risks through direct contracting and open bidding processes.
They are. This signifies that Chinese companies feel confident in the region's stability and their own capacity to execute profitable projects without massive state underwriting.
That structural maturity is a powerful force. Can you give us some key examples of where this infrastructure growth is focusing, particularly in the critical transportation sector?
Transportation really dominates the recent infrastructure provision. We see urban light rail featuring prominently, which shows a focus on sustainable urban transport solutions. This addresses real local needs and public opinion.
For example,
For instance, Chinese companies won the critical contract for Bogota, Colombia's Metro Line 1, a project that is transforming the city's transport capacity. We also see the China Railway Construction Corporation leading a $1.2 billion project for the expansion of the Monterrey, Mexico metro system.
that Monterrey Metro contract is particularly compelling. It's a high-value project in the exact region northern Mexico, where the U.S. successfully applied the most geopolitical pressure via the tariffs.
It completely undercuts the U.S. narrative that Chinese investment only exists to serve the American market. They are investing heavily in local public infrastructure, demonstrating a long-term commitment to the region's internal development.
And it's not just urban rail.
No, we also see major rail projects focused on long-distance cargo routes being developed in Argentina and Brazil to connect inland commodity sources to these new coastal ports. Companies like China Communication Construction Company, or CCCC, are heavily involved, securing over $16 billion in infrastructure contracts in the last 4 years, primarily in transportation.
This all brings us back to Mexico's new pivotal role. We heard the anecdote of the factory owner Chen rerouting his goods south. Is there physical evidence of this transformation at the port level?
There is, and it's a physical manifestation of the pivot. We can observe this dynamic shift at the port of Manzanillo on Mexico's Pacific coast. This is one of Mexico's busiest ports, handling massive volumes of trans-Pacific trade.
And what's happening there?
A senior logistics coordinator there described noticing a fundamental change in the manifest logs over the past 18 months.
What did they observe?
Well, for 20 years, their job was essentially being a gatekeeper for goods rushing toward the American border, destined for Texas or California. But recently, the containers arriving from Shanghai aren't just passing through anymore.
They're being broken down.
Broken down, processed, repackaged, and consolidated with locally sourced Mexican goods. And the final manifest destination has fundamentally shifted. Instead of Laredo, the goods are now heading south to deepwater ports, destined for final markets in Peru, Argentina, and Ecuador.
So the U.S. puts pressure on the northern border to stop China from entering the U.S. market.
And China's response is to invest in Mexico's internal transport system and leverage the country's geography to transform it into the central logistics hub for the southern market.
This demonstrates a sophisticated long-term global economic strategy and foresight in international trade dynamics.
It confirms Mexico's transformation from a simple transit point for the U.S. to a sophisticated logistics hub for the entire southern market. The intense government-to-government dialogue and massive investment flow are actively reshaping the geopolitical landscape and fostering a new era of genuine South-South cooperation.
Let's move on to that. This infrastructure is all ultimately aimed at two interconnected goals: securing resources and accessing markets. Let's look at the resource race first, because the global energy transition makes Latin America absolutely indispensable.
It truly does. Latin America and the Caribbean are vital for securing the critical raw materials, or CRMs, needed for the global energy transition, particularly lithium and copper. China's growing presence here is entirely aligned with bolstering its global dominance in strategic and emerging technologies.
From EV batteries to advanced electronics.
Everything. And the lithium triangle, Argentina, Bolivia, and Chile, is obviously ground zero for this strategic resource acquisition.
It's the heart of the lithium race.
It is. These three nations collectively hold the majority of global lithium reserves. Since 2018, Chinese companies have invested aggressively, pouring over $11 billion into lithium extraction projects in this triangle. They have systemically purchased either partial or full access to mineral mines across the world, and this region is a clear priority.
We see major players like Ganfeng Lithium and Zijin Mining actively launching new mineral businesses across the region, securing multi-decade supply streams.
And it's not just about buying the raw material, it's about controlling the entire supply chain, right down to the extraction process.
Can you give us a concrete example of these large-scale partnerships in the lithium triangle?
Certainly. Look at Bolivia. The vast Uyuni salt flats contain staggering amounts of lithium. The Bolivian government partner is the state-owned lithium company, YLB.
That's YLB, Yacimientos de Litio Bolivianos.
Right. A consortium of Chinese companies, including CATL, which is the world's largest battery maker, and CMOC, invested a colossal $1.4 billion to construct two highly advanced lithium extraction plants in partnership with YLB.
That scale of investment demonstrates immense confidence in both the resource and the political stability to execute these long-term contracts. And lithium is only part of the story. Copper remains a classic strategic metal.
Copper is essential for all renewable energy and electrification efforts, and China is the primary global buyer. Chile is the world's top copper producer, and Peru is the second largest. The economic integration here is profound.
How so?
China is Chile's largest global trading partner, and a staggering 77% of Chile's total exports to China are copper ore and related products. This isn't just a transactional relationship. It's fundamental to both nations' economies. China is securing the necessary inputs for its clean energy economy for decades to come.
This relationship extends far beyond minerals, though. The issue of global food security ties the LAC region to China just as strongly.
It's an equally vital pillar. Latin America is China's top source of agricultural imports, supplying nearly 1/3 of China's total food imports. This relationship deepened significantly in the last few years.
What were the catalysts for that?
One major catalyst was the global trade friction that began around 2018. When China increased tariffs on agricultural imports in the United States, it strongly and immediately benefited major regional producers, particularly Brazil and Argentina.
A strategic substitute.
Exactly. It cemented the reliance on Latin American food sources. And you can see this in specific food products. Look at beef. LAC China beef exports have doubled in volume over the last 5 years and now account for over 3/4 of China's total beef imports.
Strengthening food security partnerships.
And this was further bolstered when China struggled with African swine fever, which accelerated the demand for alternative proteins like beef and poultry, primarily sourced from South America.
And soybeans.
Soybeans are crucial. Brazil alone supplies 93% of LAC's soybean exports to China. This trade ensures stable food supply for China's massive population while providing reliable, high-volume income for major Latin American commodity producers.
I find the diversity of investment fascinating. Does Chinese investment remain uniform across the whole continent, or does it vary by sub-region and local economic needs?
It varies significantly, which reflects that nuanced, tailored approach we talked about. Chinese state entities and private firms are smart enough to adapt to regional strengths.
How does South America differ from Central America in terms of investment focus?
In South America, investments are overwhelmingly dominated by energy, minerals, and mining sectors, reflecting the region's resource wealth. We see significant mergers and acquisitions, M&A, focused on securing existing assets and infrastructure.
Like what?
For instance, the State Grid Corporation of China purchased Enel Peru for $2.9 billion, securing crucial energy transmission assets. In the renewable space, Power China purchased Brazil's Pontoon and its Ceará solar plant project for $360 million. It's a direct focus on securing and integrating into the energy supply chains of major economies.
And in Mexico, Central America, and the Caribbean, the profile is different.
Markedly different. There, the investment is dominated by manufacturing, particularly in the high-tech automotive and electronics sectors. This is driven by private firms seeking market access and efficient production hubs.
An example there.
SolarRiver, a major private Chinese firm, invested $1 billion in an electric vehicle manufacturing plant in Mexico. And crucially, private Chinese enterprises account for approximately 3/4 of investment in this region in the last 4 years.
Showing a strong shift away from reliance on state-owned entities for these specific manufacturing operations.
It confirms that the commercial logic is sound, even without direct state bank intermediation.
And when we look at that high-tech EV investment, it takes us from the abstract numbers right back down to the human level. These large investments create tangible, local, and often transformative impact. We need to ground this abstract investment with the local reality.
That's essential, because the real measure of this shift is the profound economic development we see in places like Camaçari and the Brazilian state of Bahia.
This city was devastated a few years ago when Ford closed its massive manufacturing plant, which was the economic heartbeat of the region. Thousands of jobs were lost, and community morale just plummeted.
A familiar story in industrial economies globally, the sudden disappearance of manufacturing jobs. But the narrative shifted dramatically when a major Chinese electric vehicle giant, BYD, moved in.
And their commitment wasn't just to assemble cars.
No, it was to build a comprehensive, state-of-the-art manufacturing hub, including chassis production, electric motor assembly, and the complex processing of lithium and iron phosphate batteries.
That's a huge investment, $5.5 billion, making it one of BYD's largest plants outside Asia. What does that mean for someone who lost their job with the previous tenant?
It's a complete economic and skills rebirth. Think about someone like Lucas. He was a third-generation auto worker, specialized in combustion engines, and his life was shattered when the Ford plant closed. He had obsolete skills in a dying segment of the industry.
He was then rehired by the Chinese EV giant
And put through intense, highly specialized training. He was retrained entirely on high-voltage battery systems, automated robotics, and advanced materials handling necessary for EV production.
So it's an infusion of capital and, more importantly, technology transfer.
It is. It represents an immense lifeline. It brings dignity and high-tech skills back to the region, creating a new generation of workers equipped for the global clean energy economy. The investment is not just about exports to Asia, it's about providing genuine local prosperity and strengthening the region's long-term industrial capacity.
That story really illustrates the convergence of interests on a micro level. It's a focus on mutual development or South-South cooperation that drives the political agenda as well.
And that intense government-to-government dialogue is key to ensuring the relationship is mutually beneficial, not just extractive. The political agenda in 2023 clearly promoted this convergence of interests.
A record 8 LAC presidents visited China.
And the main topics weren't just trade volume. They focused on long-term structural needs, cooperation in renewable energy, transition minerals, telecommunications, and trade agreements.
And we saw specific high-tech areas featured prominently in those discussions.
Absolutely. Telecommunications, for example, featured prominently, with Huawei and the rollout of 5G networks on the agendas of all 8 visiting LAC presidents. Leaders are looking to leverage Chinese companies' expertise and relatively low cost for essential modern infrastructure.
Like 5G and fiber optics, which are fundamental to digitalizing their economies.
And the diplomatic framework supports the sustainability aspect as well, moving the relationship beyond simple extraction towards shared green goals.
How so?
The presidents discussed and signed numerous agreements related to renewable energy and sustainable development. Brazil, Colombia, and Uruguay signed memorandums of understanding related to green and sustainable development, including joint cooperation on green hydrogen projects.
This focus demonstrates the convergence of interest to support the global energy transition and confront climate change.
Moving beyond just raw commodity extraction toward a shared agenda on sustainable development. This strategic approach strengthens regional integration and fosters a new era of South-South cooperation.
This has been a deeply informative dive. It really shows that the tariffs imposed on Mexico by North America weren't the end of a long-term strategy, but merely the trigger that accelerated a new, much broader phase of Chinese engagement across the entire continent.
That is the essential conclusion. The Mexican tariffs, intended to block Chinese access to the U.S. market, were not a defeat for China, but a trigger that accelerated a highly sophisticated pre-existing strategy.
China is strategically leveraging 2 decades of foundational investment in resources and political ties,
combined with a modern strategy focused on high-tech manufacturing, infrastructure, and renewable energy to fundamentally reshape global trade dynamics.
We've seen that strategy play out geographically, from the new Pacific Gateway Megaport in Chancay, designed to bypass the Panama Canal, to the shifted supply routes we saw in Manzanillo.
And financially, we witnessed a powerful shift from reliance on state development banks to market-driven, risk-assuming infrastructure contracts and private sector investment, a sign of deep maturation.
The pivot has solidified Mexico's role as the logistics hub for the Southern Cone and cemented Latin America's geopolitical significance as the engine room for the global energy transition.
This massive coordinated flow of strategic investment and infrastructure development ensures that the long-term trajectory is clear.
By 2035, China will compete fiercely with the U.S. for the position of Latin America's top trade partner, defining a new era of global economic power and deep regional integration across the entire continent.